Consumer lending has hit a bottom. There are also signs of an uptick, according to Sanjeev Bajaj of Bajaj Finserv. But will this uptick sustain? Here are some key takeaways of that interaction that Menka had with him at Davos.
Early signs in the last 4 or 5 weeks, we are seeing some uptick on the consumer lending side.
Okay.
But I think it's still too early to say whether this is sustainable. I'd like to see how the rest of Jan, Feb and March go before we see whether we've... I think we've clearly reached the bottom, but are we making our way up or not? Our growth, while still strong, is slower than what it was last year or the year before that. And it's conscious. We have cut out the bottom 15-20% of our approvals normally because we feel that those people are leveraged at a level where if salaries are not going up, they're not going to, or they may not end up meeting those obligations. And that's a responsibility that as lenders we must have. We can't just keep lending indiscriminately either. And I think this government, and I've been saying that for a few quarters, needs to put aside its fiscal discipline for maybe 24 months and jumpstart the economy. If not, it's going to be a more disciplined but a very slow climb back. And we'll see the budget on the 1st of Feb.
Yes.
If the government does provide that boost and the economy grows, that ends up being positive then for the sector. I'm clear we're going through a pain. I'm clear that there's something that the government needs to do to lift this economy up. And there are risks associated with it. There is the risk of fiscal loosening, and then how much you should do it. Naturally, there are experts and economists there. I'm not an economist to say that, but we need that tailwind at this point of time to rebuild the sector. If RBI were to have a liquidity window for NBFCs, and you have to set aside some GSECs equivalent of an SLR for that with the RBI as security. And against that, RBI says that, we are here to provide that last backstop on liquidity. I think it creates tremendous confidence, and you would not see the liquidity problem resulting into solvency that could happen with some of these NBFCs. The RBI does not give NBFCs standalone credit card license. Now, when I see NBFCs like ourselves for the last 15 years, we probably have the largest experience on the consumer lending side. I don't think there is anybody else who does 100,000 loans a day. We'll do this year almost 30 million loans. We understand the consumer. We have a co-branded credit card that performs very well. So one can see from experience who are the better NBFCs and give them some of these facilities, because if we have to digitize this country, if we have to enable this country and help it grow, then those companies that are doing that, you should support them as well. One thing to do is to just put or create incentives for the average consumer to buy another house, to buy another car. So I would say cut GST on autos. You could cut it for 12-18 months. Yes, it will cause some bleeding. But if the economy picks up, growth picks up, your denominator will also go up.
Correct.
Your deficit as a percentage will come back in a couple of years. So I would say that is something to do. Second is, we have talked of Make in India. We want to bring the world here. We have to be consistent then across what we do when we want to attract the world over here. And why attract the world over here? How about attracting Indian business over here? So I would say that while the move on corporate tax was a good move, but just keep one low rate for everybody.
Let's see if there is some magic that the government can pull out in the budget, because a lot of companies have spoken about some incentives needed. But let's focus fully on earnings now. First, Federal Bank, their numbers came out in trade yesterday, and the provisioning came to good use in the third quarter as slippages increased. Recoveries were higher, as did cost-to-income ratio. Joining us now to talk about the earnings is the bank's MD and CEO Shyam Srinivasan and Shefali Malik Johnson to take that conversation forward. Shefali.
Well, yes, for Federal Bank, the numbers were quite okay. They had higher recoveries as well and even higher write-offs to the tune of 300 crores. So I asked all these questions. So I'll be asking all these questions to the management. So Mr. Srinivasan, so on the backdrop of a weak macro environment, what were the factors that worked for you this time and what didn't?
Yeah, hi, thank you. Like I mentioned in our sort of press release after the results, we're quite encouraged with our Q3 overall outcomes because there were three themes that we were keen to ensure that the quarter delivers. One is we've seen opportunities to sort of calibrate and grow our retail, which is trending well. At the same time, be a little more cautious on the overall corporate given the external environment still continues to be a little sort of dodgy. The third is knowing that two large housing finance companies which are on our portfolio have challenges and recognizing them as NPAs, how do we make sure that the overall slippages for the quarter continue to be very good? And I'm pleased that if you back those two accounts, which we knew are challenges and we had already made standard asset provisions last quarter, we want to ensure that this quarter the overall slippages are contained well. And I'm pleased that outside of these two accounts, our overall slippages were at a multi-quarter low. And that happens because for now 10, 12, 14 quarters, the credit growth that we've seen have been in the segments we want, from the kind of security we want and the sort of ratings we want. So we believe that irrespective of the environment, we've been able to contain both the outcomes and ensure that the going forward also is sort of well protected. So I believe that overall Q3 is quite on track. Growth is muted in corporate, but retail and other businesses have grown 20% plus. So more or less along the lines we would like it to be. I would have been happier to see some more corporate growth, but we are being extremely watchful.
Sir, these two housing finance companies that you talked about, is there an adequate provisioning cover or do we expect more to come in the next few quarters?
It would depend on the resolution outcomes. One of them is there's an RBI appointed administrator activity going on. A resolution professional is working on it. We should see how things shape up over the next 3-4 quarters. The other is an account which we've increased our provisions, and we believe that if the resolution kicks in and the same level of intensity is put in, there is a certain degree of recovery option. But my own belief, over the next 2-3 quarters, we will increase our provision to at least 40-50% to make sure that should there be some impact, we should be able to well cushion. So it's a 2-3 quarter kind of work depending on the resolution and depending on the way things shape up over the next 2 quarters.
So what is the outlook then for the asset quality going ahead for both corporate and retail, and within corporate the MSME book, and for retail as well? We are seeing the noises increase across the sector that the delinquencies are going up, might go up from here on. So what is your outlook?
Our book is largely a secured book. We don't have a big unsecured component. And so there is a sense of how things will shape up over the next 2-3 quarters. We're quite reasonably confident that the current run rates that you're seeing should hold with some marginal band up and down, but nothing that will shift the dial materially. And on the corporate side, we don't have any big names, and I'm hoping nothing comes up in the coming quarters. So as of now, our outlook looks quite positive as of now, and how we think the next 2-3 quarters should shape up.
So you've undertaken write-offs as well in this quarter to the tune of 330 crores. So which accounts are these, and are there any recovery prospects here?
Yeah, one of them was a large account which is in the power space. It was about 200 crores and we decided to write it off by providing 100% on it. There are some recovery opportunities. Work is underway. We will see how that shapes up. These things, there is no sort of certainty when it will happen. We know that it will happen because in that power generation space there's some traction which is positive, but I can't quite tell whether it will happen in Q4 or Q1 of next financial year. But we are, all I can say is we're in a better place than we were because we're fully provided. So anything we get is an upside.
So going forward, where do you see growth coming from? Which would be the pockets of growth for you?
No, I think there are two parts to it. One is the external environment conducive for growth, and the second is where we are growing. If you take our 13% Y on Y and split it, retail and gold have grown 25% plus. Our business banking business has grown 17%. Our commercial banking and corporate banking have had much lower growth. So you can see that the segments which are more retail in nature are growing and will continue to grow for us because we are gaining share. On corporate and commercial banking, which are bigger ticket, the risk appetite needs to be higher, and we are being very watchful there, and I'm not keen to step very hard on that, so that that requires some environment pickup. So our blended credit growth for the year may be around 16-17%, and that's still about almost like 1.5 to 2 times the market credit growth. Thereby we are gaining share, and that also sets us up for FY21, and as the environment picks up we should get back to our 18-20% kind of growth rates.
So one positive in your earnings was the improvement in cost to income ratio. Is there a likelihood of further improvement going ahead?
Yeah, this quarter it improved about 100 basis points over the previous quarter. We are working to ensure that that improves further by another 100 basis points. The only variable would be the pensioning requirements that may come up should yields move one way or the other, and that's something that not really in the hands of the bank. So we are working on other elements for efficiency and productivity, like we have done, because we have a full-fledged our own ops company which is doing a lot of centralized automated processes. The level of RPA and AI based activities that are going on are all improving the overall productivity of the bank. So I believe that in the quarters ahead this momentum should continue, and as income improves the cost income ratio is bound to improve. The only one would be around the wage and pension related, which unfortunately is not very tightly managed by us. There are external factors too.
So just one last question. So what is the likely trajectory for the margins from here on?
We think we will be getting closer to 3.1 in the last quarter, and a full year of about 3.07 or so, or 3.06 to 3.07, and that run rate is what we will start building into FY21 to ensure that the margin expansion comes back, and we will push for another few basis points increase in the following financial year.
All right, Mr. Srinivasan, thank you so much for joining us, and all the best for the quarters also to come, sir. So Neeraj, that's Federal Bank. Their numbers were actually quite stable this time. With they delivered on most metrics apart from the corporate slippages coming in this quarter. Apart from that, the numbers were pretty decent.
Yeah, and I think we spoke about this yesterday as well on Countdown, that while there was an initial reaction and it did seem that the slippages were higher and therefore the markets took heed of that, but then we did an explainer on why the numbers didn't look all that bad also, because a lot of other metrics seemed okay. And the stock has duly gained. Shefali, thanks so much for putting that into perspective. You know, the next one in focus is ICICI Securities, simply because I just think the capital market plays, and we posed this question to Pankaj Murarka as well, that some of these capital market plays might, and the dominant ones might actually see some market share gains, and therefore subsequently in the years to come, if everything goes right, profit gains and revenue gains as well. So ICICI Securities came out with numbers which looked okay optically. I mean, 4% revenue growth, about 35% profit growth. Let's get in the management to talk about all of this and more. Mr. Chandok, Vijay, the CEO, Mr. Vijay Chandok joins us right now to talk about the same. Mr. Chandok, good having you. Thanks so much for joining. Just a quick initial thought of what stood out for you in terms of the quarter gone by.
As you would have probably seen, revenues are up by about 4%. Costs are down by 4%. Profit before tax is actually up by about 17%, and profit after tax is up by about 36%. Specifically, we are encouraged by the fact that our overall retail equities revenue has actually grown by about 5%. We were very focused on broad basing and growing our retail revenue, which is played out this quarter. What is also encouraging is the fact that we have shown 80 basis points improvement in market share on blended basis on the equities business. What is also encouraging is the fact that we have continued to show a great gain in NSE active customer base today, which stands at about 10%. While we have delivered these results, our returns on equity is at about 51%. So that is some of the key aspects I would like to highlight with respect to our results.
Yeah, I think one more thing that stood out was the decline in the OPEX. Now, if I both Q3, which has seen that, but also put into perspective the 9-month performance and what has led to this decline, and is this sustainable?
Yeah, so the decline that you see in our OPEX is mainly coming from the employee line item and certain operating cost items that is driving this decline. This is part of, I would say, some of the things that we had articulated at the beginning of the year. We had said that we will focus on cost efficiencies. Idea is to reduce wasteful expenses or low value adding expenses would be probably more appropriate way of putting it. So we have cut down some of our physical distribution. We have brought down our branch network during the course of this last 9 months, including in this Q3. So some quarters back, our branch network was over 200. We are down to about 178 because we found that they were not really adding as much value as the cost was being incurred. So we brought those things down. Our headcount is down a little bit, and we continue to hire the right kind of skills, particularly in the area of technology, digital, and so on. So we continue to hire those skills. But still, because of the reduction in the network, we've been able to reduce our cost structure there. So we have also looked at renegotiating some of the costs that we pay out to our various partners, and we got the net result that you see is an outcome of some of these steps that we've taken.
Okay, so despite all of these steps being taken and reducing some branches, reducing headcounts, etc., you added about 94,000 new clients in Q3. What's aiding this run rate of growth of clients?
So in terms of gains, I think it would suffice to say that customers do find our platform very easy to use. Customers do like the fact that we come from the stable and strong brand of ICICI. So that's certainly a very big plus factor. We also have I would say, it's not just, this is one part of the job done, but it's also you've got to make it easy for the customer to become your customer. So a prospect to become your customer. So I think we are as much focused on those aspects as much as anything else. So it's a combination of ease through which you're able to onboard, the combination of the strength of distribution that we have, the fact that there have been certain developments in the market which are actually facilitative, the distribution network that we have of our branches, distribution network that we have of our partners. I think it's a combination play of all these factors which is helping us. So in that sense, it would be fair to say that we have a facilitative environment for the company at this stage.
Do you have any targets in mind? What's the current broking market share and where do you intend to take it towards? We look at market shares in two ways. One is in terms of active NSE customers. So that is in the region of around 10%, a tad over 10% just now. It used to be at the beginning of this year, if I recollect, it was around 9.62 or so. So it has gone up by about close to 40 basis points. The other way we look at market share is the blended market share in terms of equity volumes. That has gone up by about approximately 80 basis points during the quarter. And then we look at also the derivatives market share. So that has also gone up by about 70 basis points. So there's been an all-round improvement that we've seen in both the equities business, the derivative business, as well as we have seen an improvement in the active customer base. So to your point as to whether we are aspiring to a specific market share, I think we haven't set any such goal or target. But what we have certainly set is that we have to keep improving our experiences with the customer,
ensuring that the customer feels good and getting what he wants when he comes to our platform. He's looking for the comfort of safety. He's looking for the comfort of liquidity. We offer that through our products. He's also looking to the comfort of the right kind of advice, which we offer through our platform, through our research, through our relationship managers. So I think our focus is ensure that you provide sustainable value to the customer. The rest of it will fall in place.
Now, when I look at your press release, it also speaks about how the distribution business split between the MF and the non-mutual fund revenues as well. Can you talk a bit about the distribution business and how do you intend to take it forward in terms of the split of the businesses as well?
Yeah, you said it right. I think the strategy is largely to diversify our product suite, to broad base our business model so that we are able to be relatively less dependent on markets. It's also asked by the customers, because if you look at our customers, they are affluent customers, they are HNI customers. These customers have got larger financial needs. It's about investments to them, it's about protection to them, it's about loans. So we felt that since we are anyway been servicing them for their investment needs, it's very natural to extend that to distributing loans. It's the same customer after all. He has those needs. We already have a relationship. Extend that to protection. Again, it's the same customer. We have a relationship and he has a need for protection. So the idea is to look at very naturally extending ourselves into these zones, these areas. Use and leverage the relationship and the comfort that we built on the investment side. And these products that I just described, the loans as well as the protection products, are relatively less connected with markets. So the idea is to build it over a period of time. Is it going to change the color in 1 quarter, 2 quarter? I would go ahead to say that we are not really looking at it as just a 1 quarter, 2 quarter kind of a surge. We will continue to remain focused. We want to build a quality franchise. We do not want to do anything that hurts the customer. We want the customer to feel happy, and this is something that takes time. It's lots of investments. So it will directionally, I would say, keep improving, keep increasing the share of the non-equities business. We've seen that over the last few years. We've seen that over the last few quarters, and we'll continue to see that over the next few quarters. Our endeavor would be to ensure that if we can make it really rounded, really more broad-based. And some of these products that we've added, since they are much more than what we had in the past, it may not be inappropriate to think that this kind of a share increase of the non-equities business could be a little faster than the past trends.
So Vijay, in effect, you're moving towards.
We are focused on.
Okay, so in effect, you're moving towards the retail wealth management business of sorts, because it gives you a higher PE multiple, and while you don't look at stock prices, it certainly serves as currency.
Yeah, so you're very right when you say that, because if you look at our total franchise, we have about a little over 2 trillion in terms of assets with us. These are spread across these 1.4 million customers. But if you dissect it further, we have a little over 1 trillion rupees, so 1.1 to 1.1 trillion plus a tad over that, available with such customers who have and assets with us of over 75 lakhs per individual. So these are wealthy customers, seriously wealthy customers. And this number that we have on an aggregate level is more than 1.1 trillion. They are serviced by a team of about 300 relationship managers. They are serviced by a team of another close to 200 people who support them in form of equity advice and equity service. So we already have a fairly strong franchise. We are seeing, and we are spread across 20 odd cities. So we have a large number of penetration across the country, relationship led, large size already. And we believe that, with some of the newer products that we've added and we have intensified, it'll help us simply increase our presence with these already rich affluent customers.
2 brokerage notes, my final question really, 2 brokerage notes said that FY21 onwards, you will see ICICI Securities restarting its growth journey. Did Q3 or the 9 months of the current fiscal show that promise?
Well, we are encouraged certainly with what we saw in Q3, but we also need to keep in mind that we did see some kind of an broader based market rally in Q3 in relation to Q2. So if the market broad-based growth or I would say improvements take place, I think it certainly helps a franchise like us. What we have done and we worked really hard is to ensure that when this kind of a growth comes in the market, we are well positioned to capture that marketplace. So what I can tell you is that I think our work is all led us to be well prepared to capture the upside opportunity as and when it comes, and we'll continue to focus on that because that is something under our control. Now, if the market plays out in our favor, I think it certainly gives us a lift. So we will certainly, to answer that question, I would still say we are well positioned, but the market has to be continuing to show the kind of trends that we saw in Q3.
Okay, we'll leave it at that, Mr. Chandok. Thanks so much for taking the time out and speaking to us and giving us your thoughts. That's ICICI Securities, though the stock isn't quite reacting to what arguably looked a fairly decent quarter. But the market's too absolutely flat, so maybe it's a factor of the markets as well. And the bank nifty is actually in the green, which is not a bad sign after the strong cuts that we saw yesterday. It's a wrap on this leg of Indian Open today, though. Up next is the F&O show. Stay tuned to BQ Live.